If you're looking for cash flow and you invest your money into SDIV, which is a high dividend ETF, then this right now at the time of recording this video is a 7.25% annual yield, which means you would have to invest right around $530,000 today in order to get this $40,000 a year passively. If you invest your money into VYM, which is a Vanguard ETF for dividend stocks, this pays right now at the time of recording this video a 3% yield, which means you would have to invest right around $1.3 million today in order to get the $40,000 a year. The same concept applies here to ETFs as it does stocks. This is not something where you're just gonna write a one-time check today. If you really want to do this the right way, this is where you're going to want to have your money going into your investments every single month or every time you get paid. That way you can build this machine over time that is constantly paying you. And if you invest your money into a good machine, good stocks, good ETFs, then not only is your machine going to become more valuable, but your machine is going to be printing more money because the companies in your machine are making more profits, so they're paying out bigger dividends. A third very common way to invest your money for this passive cash flow dividends is by investing your money in REITs. A REIT is a real estate investment trust, and technically a REIT is a stock, but people look at stocks and REITs a little bit differently just because stocks give you exposure to companies like McDonald's and AT&T and IBM. REITs give you exposure to real estate. So a real estate investment trust is a company that invests in real estate, and they kind of get their own kind of special classification within the stock market because when you invest in a REIT, you are pretty much investing just for cash flow, because the way REITs work is they have a 90% rule, which says that REITs are required by law to pay out 90% of their profits to their shareholders, people like you, through dividends. And so REITs make money through rent, and they have to pay 90% of the profits out back to you through dividends. So REITs pay out a whole lot higher dividends just because the whole point is to get this income through rent and then pay it out to you. The advantage for you to invest in REITs is you don't have to deal with all the headache of trying to find the right properties, dealing with contractors, dealing with tenants, dealing with property managers. You're just investing your money into the company that manages and owns the real estate. A couple examples of REIT ETFs that give you exposure to a basket full of different REITs. Again, I'm not telling you what to invest in, just examples are SCHH. This is the Schwab REIT ETF. And then VNQ, this is the Vanguard REIT ETF. When I say Schwab and Vanguard, these are just different companies that create and manage these ETFs. If you're not sure what I'm talking about, I already made a video where I explain what Vanguard is and what Vanguard funds are. That video will explain all of that. So if you want to watch that, I'll link that video for you in the description below. But SCHH right now at the time of recording this video is paying 2.8% a year, which means you'd have to pay right around $1.4 million today in order to get this $40,000 a year. And with VNQ, you would have to invest right around $1 million today in order to get this $40,000 a year passively. If your goal is purely just cash flow, at this point you might be thinking, all right, well, if I'm just trying to make as much cash flow as possible, I should be looking for funds and stocks that pay off the highest yields. And you might be thinking, okay, stocks are a little bit risky because I don't know or don't want to do all that research, then I'll just put my money into an ETF that's paying the highest yield. The thing that you want to pay attention to is that you never want to make an investment decision solely based off of this yield right here, because this yield can be deceiving. This yield is based off of the current share price, the current stock price that a stock is trading at. And so if a stock is tanking, then artificially a dividend yield can look so much higher because the stock price is down and the dividend might not have changed yet. And so you might buy into a stock or ETF thinking that you're getting this amazing yield, but what could happen is this ETF or this stock is on the verge of failure, which is why your yield looks so high. So you never want to look and make your decision just based off of what the yield is. That's one factor that you can pay attention to. But you really want to look at the underlying fundamentals. What companies are in the ETF? How strong are these companies? What sectors are they in? Are these strong companies that will be around in the future? Same with stocks. You're going to have to do a lot more research and kind of upkeep here, because if you're investing in one stock or a couple of stocks for the long term, you want to make sure that these stocks are continuing to perform and continuing to grow. With an ETF, you really just want to kind of get an idea of the company that is managing this ETF. Like Vanguard is one of the most reputable companies out there when it comes to ETFs, because they were like the pioneers of index funds. And so you just kind of got to get an understanding of who is managing your money or what companies are you investing in, because you want to make sure that this company or this fund that you're investing in is going to be around for a long time and it's going to continue to pay you for a long time in the future. Now, when you're investing for cash flow, you got to understand the drawbacks. Because we're investing in one of these companies, these are big established companies. And the reason why they're paying out a dividend to you is because they have so much money in their account that they don't know what to do with it. So the best use of this money is just to pay it out to you, the shareholder. You can compare that to a startup company, where this company, a startup company, might be using all of their money and more to grow as big as possible, as fast as possible. Like you might have heard that Uber was losing money for so many years. They were not profitable. Why? Because they were spending every penny that they had to grow quickly. And so not only were they spending all of their money, they were also losing money because they kept raising more money, getting into more debt. That way they can use this money to grow bigger. That way their company would become more valuable. So a company like Uber could see the stock price grow very quickly. I mean, they could see a 20%, a 50%, a 100% growth in revenue, and it really wouldn't be too surprising because they're a startup company and they're trying to grow very quickly. And so they're trying to see their stock price explode. You can compare that to something like McDonald's, where you're not going to see 100% growth in the revenue like that because this company is not in that same ballpark. McDonald's is very big. They're very established. They're just trying to slowly keep growing their stores and keep growing their income slowly. That way they can just kind of maintain their dividends and maintain their growth. So this is where you kind of really got to understand what your goals are, because dividend companies are not going to give you that massive growth versus a startup company could. But at the flip side, a startup company also has more risk. A startup company could fail. It could go bankrupt. I mean, there's a lot of risks with investing in a startup company. With these companies, you have less risk. I mean, they can still fail. There's less risk, but you're not going to see the massive boom in the stock price that you could see with a startup company. I mean, over the long term, yes, you want to see the stock price go up, but your goal here is just that consistent cash flow. So you want to keep that in mind. The second thing that you want to make sure you understand are taxes, because now when you make this dividend income, it's taxable. The IRS is always going to want to get their cut when you make money. The way I want you to think of it is like a machine printing money. And the way that you can get more machines printing money is by using more money to buy more machines. So you have this one machine that's printing you money. And anytime it prints you money, you take this money and use it to buy another money printing machine. Now you have this machine printing you money, and when it makes you money, you use this money to buy another money printing machine. And now this money printing machine is also making you money. So now the first money printing machine is making you money, the second money printing machine is making you money, and you take all this cash and you use it to buy a third money printing machine, and on and on and on. This is what compounding is. And this is what they call DRIP, D-R-I-P, in a lot of stock brokerages, where you're now reinvesting your dividends automatically. The thing that you have to understand here is, yeah, you can take all of your dividends and reinvest it, which is good. It's a way for you to grow and accelerate your cash flow, because now not only are you putting more money into your investments every single month, but you're also using your profits from your investments every time you get paid to buy more shares. That way you're really just kind of building a big machine that's going to keep producing you more money year after year after year. But the thing that you have to remember here is, even if you don't take any of these dividends out and put them into your bank account or use them, you're still going to have to pay taxes on these dividends. So even if you reinvest all of your dividends, you're still going to have to pay taxes on the dividends that you received, even if you never use the dividends in your own personal account. Now, this is assuming that you're investing in dividends in your own personal account. If you're investing in dividend stocks through an 401k or an IRA or one of those tax deferred accounts, then you don't necessarily have to pay taxes on those dividends depending on what your account is. But if you're investing in your own personal account, then you're going to have to pay taxes on your dividends, even if you reinvest all of your dividends. Now, that's not a bad thing. I don't want you to stop investing your money or reinvesting your money because you're going to have to pay taxes on your profits. It's just something I want you to be aware of. So if your goal is to build up this machine that's paying you with cash flow, that way you can live off your dividend income, what you got to do is first figure out what you want to invest in, stocks or ETFs, or which kind of basket of stocks and ETFs. Second, anytime you get paid now, you're going to take a portion of your paycheck and automatically invest it into the stock or ETF that you want. Third, now when you get paid through your dividends, you want to reinvest these dividends back into your stock or ETFs. That way your dividends are building you more machines that are producing you more cash flow. Now, not only are you investing more money every single month, but your money that you're making is also going back into your machines to buy you more stocks and more ETFs. And fourth, you just got to remember that you're going to have to pay taxes on the dividends that you made, even if you don't get to put them in your own personal bank account today. If you do this, you're going to be building up a machine that's going to be building up your cash flow. And yeah, it's going to start small, but over time, you're going to start to see this dividend machine grow faster and faster and faster because you'll have more money going into your dividend accounts, and your dividend accounts are going to keep producing more money, which is going to go back into them, buying you more shares that are paying you with dividends. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.